Okay, welcome everyone to the March Open Analytics webinar. I'm James O'Donnell, the Managing Director of Open Analytics. It's just me today, flying solo, to cover what I think is a pretty interesting topic, which is non-bank lenders' credit portfolio trends. So basically, we're going to share some of the data that we have on the non-bank market. Before I start, I should say you should find on your screen somewhere, usually at the top right, a little question mark. So feel free to click that and type out any questions at any time. We'll have probably a little bit of time at the end for questions. If we don't get to your questions, don't worry. We'll actually, when we send this pack out after the session, we'll actually have a Q&A and we'll answer all of your questions in writing. Okay, let's get into it. So just a word on the data sources behind all the analysis that we're going to share today. So most of the data I show will come from Open Analytics Credit Portfolio Manager. And what that is, it's a pool of data that comes from our clients. So we host portfolio monitoring, we provide a benchmarking service and IFRS 9 ECL models, so your expected loss and your risk estimates. We've now just sort of reached the point where we've got a big enough data pools for our mortgage books and asset finance that we think we've got some worthwhile data to share. So we're going to show, it's all anonymized, benchmarking sort of market averages on performance for those two portfolios. The main performance measure we'll show in almost all of the charts is a annualized 90-day default rates, and it's also exposure weighted. So we're just looking at the rates over whole years that loans go to 90 days past due. I'll also share a few of the public data sources, so ASIC, APRA and ABS, so for a few of those other sort of headline indicators. Okay, so starting with the current state of the world. So, and I should preface this by saying all of the data that we have right now, none of the impacts of the recent Iran war and sort of oil price increases have hit the data yet. So you'd probably think of all of this data as sort of the starting point of probably a bit of stress to come. We'll start with business insolvencies. So first time insolvencies is on the left. So that really sort of squiggly line there is simply the monthly number of ASIC insolvencies. So the number of businesses that go insolvent. I've put it's a bit noisy because every January the numbers dip because there's not many insolvencies over the new year. So I put a 6-month moving average through the line there. The other line on that chart is the dashed line is the number of ASIC registered entities. So that's a proxy for the number of businesses out there. So you can see the insolvencies really shot up from around 500 to almost hitting 1,500 in about a 2-year period. That it looks like we've hit the peak there for now, big asterisk on that. So it actually has started to come back. But that growth, it's really important to understand that growth in the raw number of insolvencies is really driven in a large part because there's a lot more businesses today. So there's been about 1 million businesses added since COVID. So the chart on the right sort of normalizes that, and that's a simple insolvencies divided by the number of businesses. So you can see there the dashed line is a long-term average. So that insolvency rate, you can see it's actually just crept up to around a 25-year average. So if you sort of zero in on the last few years and just look at the raw numbers, you can get a bit of a misleading picture on insolvencies. The rate at which businesses are going insolvent is pretty normal at the moment. So it's actually not a concern, the number of insolvencies out there right now. Moving on to some more public data. Now, this is the APRA reported bank 90-day default rates for mortgage books. So this is a pool. APRA actually collects all the ADIs out there, so all deposit takers, including all the big 4 banks and all the banks, other banks out there as well. And you see that these are just spot 90-day rates. So these are, they call it the non-performing rate, but it's either loans that are either 90 days past due or loans, excuse me, someone just called, or loans that are under hardship arrangements. So the total market there, sort of 87 basis points, relatively under control. Not surprising, I've split it by LVR there. The higher LVR 80 plus LVR, typically mortgage insured mortgages of a higher default rate. That's pretty normal. And that's actually a fairly small part of the market. So mortgage arrears are actually pretty under control. Now moving on to the Open Analytics pool. So this is the Open Analytics sort of non-bank lender pool. So I've split the data into 3 groups, so prime, near prime, and subprime. I'll explain what those mean a little bit later in the presentation. The prime is probably more analogous to the bank lending. So these are typical mortgages hitting about sort of, just under 1%. So still relatively low. The scary number there for the subprime. So you look at that series consistently between 5 and 6% default rate. So for some of you on the call, that will seem like a pretty scary number. A really important caveat is that this is a pretty small proportion of the Australian market. So there's none of this subprime lending at the banks. It's less than 10% of lending in the non-bank market. So it's anywhere between 1 and 2% of Aussie mortgages are in that category. So although that pocket is stressed, it's actually very small. Asset finance, we're seeing asset finance 90-day default rates. So this is your non-bank asset finance lenders, annualized default rates. Pretty flat for the last 12 months, really. So similar to the insolvencies, dipped post-COVID and sort of got back to a pretty normal looking level. Okay, so to summarize all that data, really I would say business insolvencies and loan arrears are pretty moderate. So they're near sort of long-term averages. Unemployment rate is still very low, and interest rates, which I'll go into in a bit more detail, are actually still below average as well. And it's probably those 2 things that are the reason that we haven't seen that much stress in credit portfolio books yet. Inflation is hurting some particular industries and sub-segments, typically small pockets where inflation has caused some stress for some lenders. And that is before the effects of the Iran war. And then, of course, the big caveat sort of circled there at the end, as I mentioned at the start, none of this data has the impacts of the recent increase in oil prices. So I'd say the future is very uncertain, but suffice to say, if the conflict isn't resolved quickly and oil prices stay where they are now for a long period of time, it will cause damage. So inflation is already tipped to potentially hit around 5% because of what we've experienced already. So hard to quantify the impact, but I'd be expecting some more stress on loan books if this isn't sorted out pretty quickly. Okay, so moving into a bit more detail on our non-bank resi mortgage pool. So I'll start with something which I think is a bit surprising. So we've been trying to look at the effect of rate rises, and no matter how we sort of slice and dice the data, we aren't really seeing any sort of impact from the recent rate rises. The way we did this, we took our pool over about a 3-year period, and we split all the data into 3 groups. Those on the left there are those that at the snapshot date where we're taking the performance, the interest rate is either the same or even slightly lower than it was when the customer originated their mortgage. The middle group is sort of increase of up to 2%. And then the far right group is those who have hit the brunt of those rate rises. So these are really customers that originated their mortgages when the interest rates were near zero and have had rises of up to 3.5%. And we actually see the performance isn't worse, actually slightly better on that pool. This is the whole pool together. Whether we slice it on the prime or subprime, we see the same effect. So not really any impact from the rate rises so far. And this is exactly what we're seeing at the major banks as well. Same sort of thing, 90-day rates are still pretty flat. You saw those APRA numbers. There's no evidence that the rate rises are a major cause of loan default at the moment. Why is that? I'd say in some sense, I think it's a simple answer. I think the interest rates are still far too low to be causing systemic stress. So there's a chart of the cash rate since 1993 when the RBA started targeting inflation with the interest rate. We did see during the GFC, we do a lot of work with the major banks' capital models. We did see some reasonable evidence that rate rises caused some stress on mortgage books back, around the GFC. But that's when interest rates, climbed from around 5% up to 7.25%. And even with interest rates at that level, the increase across the big four banks in Australia and in New Zealand was pretty similar, was around 60 to 70 basis points. So less than a 1% impact on 90-day default rates. So even at those levels, the impact of the rate rises as a cause of loan defaults for mortgages was actually still fairly moderate. And of course, everyone knows that, Australia really hasn't had a recession since the early 90s when interest rates were, 4 or 5 times higher. Look, I get it that, loan balances are much bigger today, so we wouldn't need to get to those levels to cause real mortgage stress. But I think I'm pretty confident saying that the interest rates would have to get a fair bit higher than they are today for that to be on its own a cause of mortgage stress and defaults on loan books. Okay, something related to interest rate that is a very strong predictor of credit risk is actually the interest rate margin. So this is almost like a Uber or Meta risk indicator that we use, when we're looking at our clients' data or when we're doing sort of credit ratings for some of the private credit funds. You can tell a lot about the risk of any loan and any type of lending by the risk premium or the rate charged over and above the cash rate. So the margin here is the facility rate on the mortgage in this case, minus the cash rate. And you can see I've sort of banded our pool into groups there. Again, we've sort of taken the last few years of snapshots. And you see at the far left, those are the mortgages that are getting really, really low rates. So you see those ones at about 1 to 2%, 0.5% default rates, and it pretty quickly ramps up. You can see at the very risky end, you're getting mortgages in our pool with 5-6% margin. So these are mortgages with interest rates around 10% today. You can see that effect is very non-linear. And what you tend to see is once you get too far out of the market norms, the risk really does sort of exponentially increase with the interest rate margin. And this is in fact how we have a bit of a proxy definition for the kind of subprime and prime mortgages. So even for lenders, what the margin tends to be very highly correlated with is the bureau track record. So those subprime lenders with margins 4, 5, 6%, even without seeing their bureau file, you can be pretty sure that these lenders have a dirty bureau. So that's lenders with clean bureau and options won't pick up loans at that rate. The near prime in the middle, they'll tend to have a bit of adverse and probably a bit outside the risk appetite for the banks. And then the prime is pretty similar to what's at most of the banks. So really powerful factor. And if you're missing data and you want to understand the risk of any loan book, look at the margin. Other mortgage drivers that are common ones, the old sort of self-employed versus full doc, low doc. So I've shown these side by side because it's well known that low doc mortgages are a little bit higher risk than full doc, and you can see that on the right there. What I think it is, I actually think it's a proxy measure. So there's a very high overlap between low doc and self-employed, not quite 100%, as you can see from these charts. But I think the difference in risk is not actually driven by the lower financial verification and the type of loan documentation. The low doc in Australia is still NCC compliant. It still is a reasonable verification of income. What it is really it shows the difference in risk profile between regular salaried 9 to 5 employees versus borrowers that are also running a small business. So that's what we really think the low doc mainly captures. Where it gets interesting is if you start looking at factors like the self-employed versus regular salaried at different margin brackets. So you can see on the left, we've got the sort of the prime, very low margins. What I've done is I've sort of separated into 1% margin bands. Less than 2% self-employed just basically don't get offered that pricing. So if you look at that 2 to 3, You can see there's a difference in risk, but the low margin self-employed / low doc are still pretty okay. So business lending tends to have a sort of bit of a natural floor. It doesn't get down to the 50 basis point and below type risk. Interestingly, the near prime, which is the average for our sort of pool in the non-bank space, there's actually not much difference between regular salaried and self-employed. And then in subprime, and you see this with a lot of factors, that there's really non-linear effects. So the self-employed influence is actually bigger on the subprime lenders. So you see that gap between self-employed and salaried on the really high margin loans is bigger. So, a small business owner with a bit of a dirty bureau is much higher risk than a regular salaried employee with a bit of an adverse sort of track record. LVR is the other obvious risk driver. These results very much mirror what we see qualitatively at the big banks as well. So you see that relationship between default rates and LVR. The risk, again, is very non-linear, and obviously LVR is a predictor of both default rates and also recoveries and loss given default. Very non-linear after 80%. So once you get to sort of 80, 90, the risk really ramps up. What we also find at the other end is once you get to about 70, that's where things bottom out. So there's not much difference in default risk for a loan at sort of 70 versus 60 versus 50 LVR. And we really see exactly the same thing at the major banks. Again, you can look at the LVR effect at different margin brackets as a proxy for the borrower credit quality. What you will see is that LVR, no matter how you slice and dice your data, the LVR will be a strong factor across any dimension, including the margin. So you see in the middle there, pretty strong difference between the less than 70, 70 to 80 and 80 plus. Again, on the low risk side, that trend persists. And then again, on the higher risk borrowers, once you start getting that combination of a high LVR and the quote subprime borrower with an adverse bureau, you start getting some very high default rates there. Okay, and then obviously, as I mentioned, LVR is why it's the most important factor for mortgages is it drives both default risk and your loss given default on those loans that do default. So on the left comes from our industry LGD model. This is trained on big pools of collateral recoveries, and it's the relationship between average loss given liquidation. So that's the loss rates on defaults where the property has to ultimately be sold versus LVR, and it's split by region. A very big difference on basically the population density or where the property is. So the major cities versus inner regional versus remote. And no surprise to anyone, the chart on the right, things get very non-linear once you get property market downturns. So that's sort of showing 10 and 30% sort of downturns in property prices. So you can see that this is for an inner regional property. If you look at, say, 70% LVR, normally in a benign period, you're pretty safe at that level of LVR. You'll generally get a full recovery, but in a property market downturn, you absolutely do get LGDs around that sort of 15 to 20% for remote and regional properties in property market downturns. Okay, to summarize what we see on the mortgage books. So, the key thing about mortgages is the risk is really dominated by a handful of factors. So I've got a list there of what are the most important risk drivers for mortgages. The first 2 or 3 really tell you a lot. So if you know the LVR, the margin, and the borrower's income, those 3 things will explain 80 to 90% of the risk. Then some of the other things like the employment type and the location are important too, but you can tell a lot about the risk of a mortgage with just the top 3 on that list. The most important economic drivers to keep an eye on, property prices is still by far the most important. For those with reasonable LVR policies, you'll only really see significant losses if we get big property price downturn. And then unemployment, which drives all credit portfolios, and interest rates to probably a lesser extent than is probably thought by a lot of people out there, I think. Okay, so moving on to our sort of non-bank business lending world, and again, we'll focus here on our asset finance pool. Again, the margin. So really interesting to see the default rate versus the interest rate margin here. Obviously, the margin is much higher on business lending than property secured consumer lending. So you can see there a very strong relationship between the default rate with margin. So the other really interesting feature, I think specifically of non-bank commercial lending, particularly in asset finance and unsecured, is tends to be less focus on financials. So often what we see in a lot of credit scoring and policies, you actually need to get hold of proxies for things like the revenue and assets of the business. I'm starting here with probably a classic one, the sort of renter director versus owner, sometimes referred to as asset backed versus non-asset backed. What this, renter directors are typically single director companies or sole traders, and they almost always will be very low revenue, low assets businesses. So what this factor really picks up is it's a proxy for newer, lower revenue, lower asset businesses, and unsurprisingly, big difference in risk between renters versus owners. The other point here is that this market is quite dependent on the non-bank space, because a lot of the big four banks actually have very explicit policy declines, actually just won't lend to a renter director. So this sort of market is really serviced by the non-bank lenders out there. Another interesting size proxy. Now we've showed this, some of you would have seen this chart before in other presentations we've done. It's a look at asset finance default rates by the entity type. On the left there, I've split out incorporated entities by the number of directors. So you can see at the far left there, 5 director companies through to 2 and then 1. So really what this is a size proxy. So you don't get many five director companies that don't have pretty strong assets and good revenue. Conversely, single director companies are almost always much smaller, micro SME and smaller entities. Most of the renter directors are actually in that category along with the sole traders. So really, again, it's useful factors like this can help things like credit scores and really understanding your risk if you're not capturing the financials on the actual business revenue or business assets. Industry, which is also always topical, a change here. This is the first time, we report this data quarterly. We look at this data quarterly, and for the first quarter, transport has actually jumped to the highest risk in our asset finance pool, driven a lot by prime movers and actually a lot concentrated in Victoria prime movers. So it's actually overtaken food and beverage or hospitality. I've circled construction there because it's actually performing pretty good. So a lot of asset finance is concentrated in construction. It's actually slightly below the population average. So construction so far has actually been performing pretty well. A very important sort of note on that, of course, this is our asset finance pool. There isn't a whole lot of asset finance lending to hospitality. If you look at other types of lending, particularly unsecured lending, or in this case, I'm just looking here at the national insolvency rates. This is a Creditor Watch provides their business risk index reports insolvency rates by industry. So this is a national statistics. So you can see food and beverage there circled. They're double the nearest roughly in terms of insolvency rates. So more generally for unsecured lending, hospitality is still by far and away the riskiest business at the moment. But then you can see on this chart, the top 3 is the food and beverage, transport and construction. So we sort of see those as our watch list industries, so the ones we're sort of keeping an eye on at the moment. And all 3 of these are sensitive to inflation and oil prices. So transport, obviously, food and beverages really gets hit by inflation because it dries up discretionary spending, and then construction is very energy intensive as well. So all 3 of those are susceptible to what's going on with oil prices. And again, here I've actually separated out the renter directors. So you can see those sort of low revenue, low asset businesses in these industries are quite high risk. A few more to go before I open up for a few questions. Asset finance, risk by business age from our pool again. I always like to show this chart because it surprises some people where the peak is. So the peak 90-day default rates on asset finance loan books are for businesses between 4 and 5 years old. So really the risk climbs up to about 5 years. And then after 5 years, the risk steadily declines. So I think in a lot of credit policies, people assume that peak happens a bit earlier, so 2 or 3 years, but yeah, it typically does take a while. The other interesting point here is the renter directors on the same chart, same peak at 4 to 5 years, but you'll notice that it doesn't really drop to a low level. So even businesses 10, 15 years old that are, run by renter directors still have, 5, 6% default rates, which is still quite high for asset finance. Remembering this market, the average for the non-bank asset finance is about 3.7%, probably about 2.5% at the banks. So even mature businesses with renter directors are still pretty high risk. One more sort of factor to go, and that's location risk. We could do and we probably will do a whole webinar on this topic. There's a big difference in risk for commercial lending across different regions in Australia. So this just shows default rates by Open Analytics Business Location Risk Indicator. It's a model that it combines a lot of different data sources, but suffice to say, it basically breaks the country up into regions by their relative risk. So it's like a postcode risk measure, and you can see the very strong relationship there, and really big difference between the best and worst regions, particularly for those renter directors. So you can see those renter directors in the highest risk geographies, they're really, they're hitting sort of double-digit sort of 90-day default rates. And then just maybe to make that same point, but maybe a little bit less abstract with just some hard insolvency numbers. So I've taken Queensland and I've just broken it into all regions that have at least 1,000 employing businesses. And I'm just reporting the annual insolvencies as a percentage of the employing businesses in the region. So Queensland is the highest risk state, so it has the highest rates of business insolvencies. But I think often the whole state gets tarred with the Southeast Queensland brush, because it's definitely very high insolvency rates around Brisbane CBD, Gold Coast and Surfers Paradise. So those big population centres in Southeast Queensland. And for that reason, a lot of, this might be one for the funders on the call. Funders will have strict concentration limits to high risk states. What I would say is by land area, most of Queensland is actually quite low risk. So if you look at central Queensland and far north Queensland, areas that are really supported by primary industry like agribusiness and mining to some extent, those centres are actually quite low risk, quite a long way sort of below the national average. So, you might, I think some funders and lenders can sort of rethink the way they look at concentration risk measures at a state level, because it's the same within any state. There's quite big differences within each state in terms of the credit risk. Okay, so final slide. Probably the call out for business lending, and this is more of a general point, unlike property secured lending, things like asset finance and unsecured business lending, they're more varied risk drivers. So you can't really boil down the risk in the same way that you can for a mortgage book into a couple of factors. A list there of what we'd see as some of the key factors. I'd say number one is size. So if you can get hold of anything related to the revenue or the assets of the business, that will show the greatest separation. We see that when we build rating models for the big banks. If you don't have that, get whatever proxy you can, things like number of directors or the renter director, margin, of course, a few others there. Probably the one that may be underutilized is probably that location risk. And then the sort of economic indicators to watch out for, really inflation and GDP are the sort of key drivers. Okay, that's it. There's a few references there. We'll send this pack out. And as always, our contact details are there, so feel free to get in contact. I realise I've gone very hard up against the time limit there, so might have to see if there's any questions. Yeah, we've just got one, so I'll just cover one question. So there's a question about what about for asset finance? What about the assets securing the loan? Aren't they an important driver of risk? The answer definitely to that one is yes. Long presentation, as you saw, actually on the left on the cutting room floor, some of our benchmarks on loss given default and recovery. So yes, the primary, secondary, tertiary assets, there's a big difference in loss given default, but generally not for probability of default. So generally the quality of the asset actually doesn't drive the default risk, but it does obviously sort of drive the recovery risk. All right, so thanks everyone. I think it was a bit of a long presentation, so thanks for your patience. So hope you all enjoy the rest of your day and have a good Easter break. Thank you.